Many small business owners want to help their employees and themselves save for retirement. But setting up a traditional retirement plan, such as a 401k, involves costs and paperwork that might be too much for a small business to handle. However, the IRS has created two programs that make creating a retirement plan easy for small businesses. In this video, we're going to look at one of those plans. I'm the Tax Geek, and here are Simplified Employee Pension Plans, or SEPs, oversimplified. Under a SEP, a small business sets up separate SEP-IRAs for their owners and each eligible employee. Unlike ordinary IRAs where contributions are limited to $7,000 or $8,000 per year, SEP-IRA contributions are limited by the rules of the plan, which we shall look at shortly. Like ordinary IRAs, SEP-IRA distributions are taxable and may be subject to a 10% early withdrawal penalty if a distribution is made before the participant reaches age 59 and a half. Under a SEP, only the employer can make contributions to the SEP-IRAs. There is no provision for employees to make their own contributions. All SEP-IRAs are traditional. Contributions are deductible by the employer when made and taxable to the employee when withdrawn. There is no Roth SEP-IRA option. The financial institution holding the SEP-IRAs often provides several investment choices with varying degrees of risk. It is up to the participant to make a decision as to how their accounts are invested. SEPs have minimum participation requirements. For an employee to participate in a SEP, the employee must have reached age 21, worked for the employer in at least 3 out of the last 5 years, and have received at least $750 in compensation during the current year. Please note that these are minimum requirements. An employer can make the requirements more generous, such as lowering the participation age to 18 or requiring just 1 or 2 years of employment. However, they cannot make the requirements more restrictive. Contributions are based on a percentage of compensation, which, for an employee, is usually the gross amount of compensation shown in Box 1 of Form W-2. Contributions can be up to 25% of the first $330,000 of compensation. Contributions are entirely at the discretion of the employer or owner. However, the percentage must be the same for all participants, including any owners. All contributions are 100% vested when they are made and can be immediately withdrawn by the participant, albeit subject to income tax and possible penalty for early distribution. For owners who are sole proprietors or active partners, compensation is defined as either the net income from Schedule C or Box 1 of the partner's Schedule K1, less any adjustment for 1/2 of self-employment tax and not include the contribution itself. This usually means that as a practical matter, compensation for both the employers and employees cannot be determined until after the end of the year. However, like all IRAs, contributions to SEP-IRAs can be made up until the due date of the return, including extensions for that particular year. For employers, setting up a SEP is extremely easy. IRS Form 5305 SEP is simply a model SEP agreement where the employer sets the requirements for participation that cannot be more restrictive than the requirements mentioned earlier. This form is never sent to the IRS. It is simply a template for the terms and conditions of the SEP. The employer then goes to our financial institution and establishes the SEP-IRAs for each eligible participant. A copy of Form 5305 SEP and its instructions must then be provided to each participant. As usual, an example is in order. Howie is a sole proprietor who owns a plumbing company called Flushed with Pride. He employs 4 plumbers: Darren, Aaron, Karen, and Freddie, all of whom are over age 21. Darren, Aaron, and Karen have been working for Howie for at least 5 years, but Freddie is a new employee, hired just last year. Howie decides that the best way for him and his employees to save for retirement is through a SEP. He prepares Form 5305 SEP and decides that the regular minimum participation requirements work best for him and his employees. Under the SEP, Howie approaches Retirement Bank and sets up SEP-IRAs for himself and Darren, Aaron, and Karen. Since Freddie has only worked for Flushed with Pride for less than a year, he cannot participate at this time. Howie's business had a pretty good year this year, with net income before any SEP contributions of $136,000, and he decides to make a contribution to the SEP-IRAs of 5% of compensation. In that year, Darren made $65,000, Aaron made $52,000, and Karen made $71,000, so their SEP-IRA contributions are $3,250. $2,600, and $3,550 respectively. Now it's time to calculate Howie's contribution. Since the compensation that the contribution percentage applies to and the contribution itself affect each other, we need to modify the contribution rate to compensate for this. This is done by taking the contribution rate as a decimal, in this case 0.05, and dividing it by 1 plus the contribution rate, or 1.05. Doing this gives us a revised contribution percentage of 0.048, or 4.8%. If you don't want to do all that math, there's a handy table in Publication 560. Next, we take the net income from before and subtract the total SEP-IRA contributions made to Darren, Aaron, and Karen of $9,400. This is then reduced by 1/2 of the self-employment tax on that net income, which is $8,944. The result of these subtractions is multiplied by 0.048 and gives us Howie's $5,648 contribution. On a Schedule C, the employee's SEP contributions show up on line 19 and are an expense of the business. Howie's own contribution is reported on line 16 of page 2 of Schedule 1, and that amount, along with any other adjustments to income he may have, are entered on line 10 of Howie's Form 1040. For a partnership, it's similar. Employee contributions are reported on line 18 of Form 1065. SEP-IRA contributions for the partners are shown on the partner's Schedules K1 in Box 13, coded R. This amount is reported on the partner's personal return, same as the sole proprietor. SEP-IRA contributions can also be made for S Corporation or C Corporation stockholder owners if they are active employees and receive salaries. Their contributions are calculated just like any other employee of the corporation. Stockholder owner contributions are included with the other employee contributions and reported on line 17 of Form 1120S and line 23 of Form 1120. Such contributions are not reported on the owner's personal returns. And that's the oversimplified version of how Simplified Employee Pension Plans, or SEPs, work. Of course, there are far more details that were not covered in this video, and I encourage anyone who is interested in learning more to consult the resource material linked in the video description. The next video in the series will cover a different type of retirement plan suited for small business, the Simple, which ironically is less simple than the SEP. If you found this video informative, please give it a like and share it with anyone else who could find it useful. Subscribe to the channel to see additional oversimplifications of our overcomplicated tax system. And as always, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.